Hello guys and welcome to the ITU Forex class. In today's episode, we're going to be talking about support and resistance, okay? So for those of you who are brand new to trading and you absolutely don't know what support and resistance is, don't worry because you are going to be talking about we're going to start from the beginners guide to support and resistances, and then we're going to work our way up to the more advanced concepts, okay, of support and resistance to help you to improve your trading, okay, your trading performance. So first things first, what is support and resistance? What exactly is support and resistance? Well, let me do a quick little scribble on the charts to show you what it looks like, okay? So usually when we have price action, price does not move in a straight line, okay? Usually when price is either moving up or it's moving down, usually price is not just going to continue moving up and down or down in a straight line or up in a straight line without pulling back. And when it does this, the areas on the price chart where you'd see price rejecting, okay, where you see price bouncing off of is known as the support areas. These areas are known as the support areas. So for this example illustration I have on my chart, you can see that this area on the chart is actually a support area. Likewise, this area where price got rejected at is also a support area. Why? Because price, for whatever reason on the price chart, this particular price level is supporting price and preventing it from moving any lower. Okay? It's supporting price and it's preventing it from moving any lower. And on the upside, if I could quickly pick my pen up here, yep. And to the upside, this is what we refer to as our resistance areas, okay? The reason why this is resistance, why it's called resistance, is simply because price has tried countless times to break above the areas. Pay attention to my illustration, not the actual candlestick chart behind it, because that's what I'm showing you before we go on to the charts. Price has tried and tried and tried to break above these resistance areas, but it failed, okay? And so price is kind of the price chart, for whatever reason, is preventing price at those particular levels to continue moving up. It's resisting price, and that's why it's called resistance, okay? Support, because price is acting kind of like a floor, preventing price from going down any further, and resistance is called resistance because price, for whatever reason on the price chart, price is finding it very difficult to break above those levels, okay? So let me quickly clear my charts and let's move on with more examples on the charts, okay? So just a minute as I clear this. So what exactly does support and resistance mean when we see it on the price chart? Because right now I've just explained to you what it looks like. But what is the psychology that leads to the formation of support and resistance on the price chart? Because the thing is, a lot of traders, they begin their trading journey and all they know is, they are being told that this is support, this is resistance, this is where you see support forming on the chart, and this is where you see resistance forming on the chart. They don't actually know the logic behind its formation, which makes it hard for it to for them to translate that knowledge into an edge they can use to trade objectively. Okay, so what's the psychology behind the formation of support and resistances? Well, to cut the long story short, when you see price getting rejected at an area on a price chart, whether it be a support level or a resistance area, this is simply telling you that for whatever reason, when the sellers were selling aggressively, you can see that we have this is an example that I'm using, this price chart. You can see that for whatever reason, price tried to break above this resistance area, but it failed. And then after that happened, we had the formation of a very, very strong bearish engulfing candlestick, which is showing us that the sellers are kind of in control of the market during the formation of this particular candlestick, okay? So when this candlestick got formed, you would assume that since the sellers are controlling the market right now, think about it like a tug of war, okay? So the sellers are pulling on one side and the buyers are pulling on the other side. But then because there's just so much strength from the sellers, you can see that they obviously clearly dominated this particular time frame, this particular 4-hour chart when this candlestick was being formed. Why? Because the buyers couldn't even put up a fight. The candle closed as a red candle, closed to its very low price, and that's showing us that there's been a very strong momentum to the downside. Now, the assumption here is that when this type of candles form, all things being equal, price should continue moving down and down and down, just like we have something here, okay? It should continue moving lower. But then you can see that as price moved down a bit, instead of it to continue moving down with the same momentum that we had somewhere around here, after the show that the sellers put off around here with the formation of this candle, they couldn't repeat this continuously to keep forming lower lows and lower lows and lower lows on the candles that were printed. And so price now, they started getting weak somewhere around here. They went from forcing price to move down with a very, very strong, very large range, okay, like when this candlestick was formed, to now price finding it extremely difficult to even form a candlestick which had like kind of a 3/3 of the body of this particular candlestick. And now price is forming wicks, price is forming almost equal bodied candlesticks, and we kind of have a difficult, very, very difficult time for the sellers to continue pushing prices lower. And this leads to the formation of what is known as a support on this price chart. Why? Because when the sellers were pushing prices lower, the assumption is that if they were strong as they wanted us to believe when this candlestick was being formed, they should continue pushing prices without fear or without any weakness on their side. Not fear, weakness. But then these candles that formed after the formation of this big bearish engulfing candlestick is telling us otherwise. Because if the sellers were really as strong as they showed us, then this red candlestick with big range would have continued forming and pushing prices lower. But they failed to do that. And then we had the candles that came in here showing us the weakness from the sellers to continue pushing prices lower. And then price, for whatever reason, got rejected at this area and started to move up. Now, this area on the price chart is what is referred to as a support area, because price has tried and tried and tried to continue moving lower, but it failed to do that. Why? Because the sellers are not as strong as they made us believe, and they couldn't push prices any lower than this particular area on the price chart. Now, one of the common misconceptions that a lot of traders have is they think that support areas or resistance areas on a price chart are just plain lines. Let me show you what I mean. So let's pick this line up here, and drop it on the chart. So the assumption for a lot of beginner traders, the misconception for a lot of beginner traders is that they think support and resistance areas are just simply lines on a price chart. So if I was to show you that, okay, this is a support area on the price chart, and I picked up this line, this horizontal line, this black line you're seeing here, and I dropped it on the chart, and I told you that, okay, this is a support area, most beginners would think that if price doesn't come all the way down here, then price hasn't touched support. But actually, that's far from the truth. Because if there's anything years and years of experience and teaching, trading, and trading the markets actually live has shown us, is that these areas are more like zones or areas on a price chart. So let me show you what I mean. So you see, when price got rejected somewhere around here, let me pick this horizontal line here. You see, price was moving in an uptrend. If I pick this up, you can see that price was moving in an uptrend. Why? Because it was forming higher highs and higher lows. Higher highs and higher lows. Now, this is the example I want to draw your attention to. When price broke above this previous resistance area, okay, you would assume that when price came back down here and tested this support, this is clearly a support area. Why do I say that this is a support area? Well, let me show you why I said that. Because you see, when I pick this arrow and I show you this to you, you would see that price came all the way down here, but then it couldn't move any further down. It couldn't move any further down. It came all the way down here and it got rejected because the sellers just were not strong enough to continue pushing prices lower. And so when the buyer stepped in, price got rejected from this area and it continued moving up. Now, this is a typical example of a support area on a price chart. Now, the assumption for a complete newbie trader would be that for this particular support area to be considered a valid support area, then price needs to come to this exact area on the price chart to the exact price level before we would see that, okay, if price gets rejected, we'll say that this support area is acting up, is holding up, and then price would move either bounce off of that level and continue moving up, or break below it and continue moving down for whatever reason, okay? But that's not the case. What I'm telling you is that has, from countless of hours of backtesting and trading and using support and resistances, marking up charts and everything, that we've discovered that isn't the case at all. Because these support and resistance areas, more often than not, they act kind of like zones. So instead of you drawing a support and resistance area on a price chart with a simple line like this, you could draw it with whatever you want to draw. But you just need to pay attention that support and resistance on your price chart are not single digit levels on a price chart. What you would want to do more often than not, what would represent it better for you, would be to use something like this. Okay, so I think I have got my magnets on. So yeah, okay, I've just turned it off. So it would be to use something like this. Okay, this is a tool in TradingView. You can use whatever the horizontal tool in MT4 or MT5 if you want to get the same results. But this is basically showing you that, okay, this particular horizontal shaded area that I have on my chart is kind of like an area where price has acted as support in the past. And based on technical analysis 101, what does this mean? When support is broken to the upside, this is a support area, okay? This is a support area. So based on basic technical analysis, when support areas are broken from the top, okay, price moves from up above the support area and breaks below it. When it does this, usually that support area is now going to get turned into resistance, because when price breaks a support area from the top and it comes back to it, that area is expected to serve as resistance. And on the contrary, when price breaks a resistance area from below it, we are assuming, based on technical analysis 101, that price is going to, that particular resistance area that was broken is going to now start acting as a support area when price retests that area. So let me show you a practical example of that in action. So let's assume that this particular area on a price chart, you can see this is the reason why I told you that support and resistance is not a single digit level on your chart. Most traders fail, especially beginners, fail when they think that these levels are just single digit levels on their price chart. Why do I keep emphasizing this? It's because I've seen a lot of traders make mistakes of doing this when they are drawing support and resistance areas, when they are marking up their charts. So to give you a clear example, you can see that price was moving up here. Okay, so it came all the way up here. It couldn't break above this area. So when price fails to break above an area, what does that make the area become? It makes the area to become a resistance area, because price is being resisted from the upside from breaking above that area. Okay, so you can see that price came to this area. It tried to break above it, but it failed. And then it pulled back a little bit. It tried to break above this area again, but it failed. But then eventually when it pulled back and it came back, it broke above this area. You can see this is the resistance area I was talking about, which price came about 2 times and failed to break above. But you can see that when price broke above this resistance area and then came back to test that resistance area from the upside, this resistance area, which acted as resistance before price broke above the level, is now acting as a support area, because after price broke above the resistance, it moved up and then it came back down to test that resistance area, which is now acting as support, but it failed to break below the area. It went up, tried again, failed to break below it. Went up, tried again, failed to break below it, and it kept moving up. Now, this is based on technical analysis 101. When price breaks above a support and resistance area, that role that the support or resistance area was serving is going to switch. So if a resistance area was preventing price from breaking up above it, and then eventually price broke above that resistance area, now that resistance area is going to switch its role from being a resistance area to now being a support area. Does this work 100% of the time? Of course not. in trading, nothing works 100% of the time. But the reality is we don't even want anything. We don't need it, not want. We want it to be 100%, obviously, because we'll just be printing money by then. But if this wasn't the case, which it's not the case, I don't want you to have false hope or anything here. You don't even need that to be the case. And why do I say this? It's simply because let's assume that you're trading off of basic price action. You're not adding any indicators to your charts or doing any fancy charting techniques or anything like that. You are trading solely based off support and resistances. When price breaks above a resistance area and it comes back to it, you assume that price is going to respect that area, and so you buy. It's as simple as that. I want to show you an example here. Okay, so let's assume that you saw this. You saw that price was finding it difficult to break above this resistance area once, twice, and then eventually the third time when price broke above this area and it came back here, you saw that, okay, this is a good thing because now price is getting rejected at the area. When this red candle was printed, you'd assume that price is going to continue moving down, but it failed to do that. We had the formation of this big green candlestick, which is showing us that we had rejection here. Again, if you took a trade here at the close of this candlestick, that would have been a good trade. Okay, again, does this mean you would win 100% of the trades you take? And this brings me to what I'm talking about right now. No, it doesn't mean you're going to win 100% of the trades you take, and you don't need to. And why do I say you don't need to? Well, it's as simple as, let's assume you saw this and you saw that price got rejected at this previous resistance area, which is now acting as support. And you know that based on technical analysis 101, when price breaks a resistance area, okay, and now that resistance area is kind of like acting like support, then we're going to place a trade there. And then once we place the trade there, we'll do proper risk management, not risking more than 1% of our account's capital per trade, and trading with good risk to reward ratios. So in this example, let's assume that you thought, after you saw the price action that played out here, price broke above this resistance and it tested it back and it couldn't break below it. You took a long trade here with your stop loss just being below this area, below the resistance area, which is fair because if you have a stop loss here and for whatever reason after price got rejected here, it moved to the downside, then you don't want to be in that trade because now that support area is not holding up. And the reason why you took the trade in the first place is because you're assuming that what technical analysis, the past tends to repeat itself, that price, since it broke this resistance area and it's getting rejected here, now it's likely not going to break above it. And so you are taking the trade here and hoping for the best. Now, let's assume that you're risking 1% of your account's capital on each trade you take. And then when you saw this price action play out, you placed a trade here at the close of this big green bullish engulfing candlestick with your stop loss being somewhere around here. And let's say every single trade you take, you're going for a 1:2 or 1:3 risk to reward ratio. You can see that for this particular example, price actually did what you wanted. You were risking 1% to make a 3% profit from this trade, which actually played out. So you made a 3% profit from this trading position. Now, what does this have to do with anything? Let's put it this way. Let's assume that you took this trade and you made this profit. But then let's say that you continue trading with the same simple concept. When price breaks above a resistance area and it pulls back to that resistance area and it gets rejected, you assume the best and that price is going to continue moving to the upside. So you take the trade, risking 1%, aiming for 3%. And when price does the opposite for a support area, meaning price breaks below a support area, and then when it pulls back to retest that support area, okay, now that support area has switched its roles. It has moved from being a support area to now being a resistance area. You now sell whatever instrument you're trading at that particular area or region or price level, risking 1% and aiming for 3%. Let's assume you continue trading like that. Simple as that. You're just trading support and resistances, nothing else. Okay? Now, here's the catchy part, okay? Let's assume that you took 100 trades. Let me quickly pick up this tool here, the text tool, and to show this to you. Okay, so let's assume that you took 100 trades. 100 trades. Now, from this 100 trades you took, let's assume that you lost 60 trades. Okay, you're losing trades. Let's put it this way. Let's say you're losing trades. Okay. Losing trades are 60. Your total number of trades that you took total number of trades. Total number of trades is 100. Okay. Total trades 100. Now you lost 60 trades, but you won 40 trades, okay? Because you took 100 trades, remember, okay? Winning trades. Winning trades, 40 trades. Okay? So going with this example, moving forward with this example, you can see that we could say that our win rate is 40%. 40% because we lost 60 trades and we only won 40 out of the 100 trades we took. Okay? But then the thing is, whenever you lost a trade, you only lost 1% of your account's capital. Okay? Because why is that so? The reason why that is so is because on each trade you take, you are always sticking to proper risk management, never risking more than 1% of your trading account's capital on each trade you took. Okay? So when you took all of those trades that you took, you had 60 losing trades out of the 100. And so since you were risking 1% of your account's capital on each one of those trades you took, then when you multiply your 1% minus 1% loss, okay, times the 60 losing trades you took, your gross loss is going to be minus 60%. Okay? How about your gross profit? Well, your gross profit is going to be, because each winning trade you took gave you a positive return of 3% of your account's capital. Because you were always risking, remember, risk reward ratio, we're risking 1 to make 3. So you were always risking 1 to make 3. When you lost a trade, you lost only 1%. But when you got a winning trade, or when you caught a winning trade, you made a profit of 3%. So because of this, your winning trades, each single winning trade brought you a profit of plus 3%. Now, when you multiply that plus 3% of profit, which each winning trade gave you, times the 40 winning trades you took, you see that you end up with a profit of 120% of your account's capital. Now, when all is said and done, your net profit, which is going to be your gross profit minus your gross loss, is going to be 120%, okay, minus 60%. Okay? Minus 60%. In this case, this would mean that you would have ended up this 100 trades that you took being up around 60% in profit on your trading account's capital. Now, to some traders, especially the ones who are trading with small accounts, this might not be something that they would bat an eyelid at. So let's assume you're trading on an account with $100, for example, and you made a 60% return. That's like $60. That's barely enough to, cover your cost of living for a month or whatever the case might be. But when you're trading like this, I don't want you to be thinking with that type of mindset. I want you to be thinking the way the pros think, okay? And the professionals, they know that trading is a numbers game. They understand that if they can make a 60% return when they are trading on, when they're improving their trading skills on a small account, they only need to do the same thing they're doing on that small account on a larger account. So if you were doing the same 60% profit in a year, for example, we're trying to be realistic here, not trying to, give false hopes and everything out there. So if you were to make this 60% profit, okay, on a 200K prop firm account, for example, or, you were able to convince some investors to give you money to trade for them, and you were to split the profits or whatever the case might be. On that 200K account, this 60% profit is like $120,000. Now, all of a sudden, this is something that is worth striving for a lot of people. And if you want to make more, it's only about, getting more capital to trade with. You don't need to be flipping accounts or blowing accounts or, just doing that whole thing over and over and over and over again. Okay? So you just need to understand that trading as a whole is a numbers game. And all these numbers that you're seeing, this staggering numbers that you're seeing of profits that you made on a big account, assuming you were to trade a big account, you actually did this while you only had a 40% win rate. So you lost 60% of the trades you took, and you only won 40%, but you're still able to make good profits. Why? Because you're practicing proper risk management. Okay, it wasn't as if you lost like 3 or 4 trades in a row, and then the next trade you took, you went on and said, you know what, I'm not going to risk 1% again. I want to make back the money I lost, and I'm going to be risking 4%, so that even if my trade just goes 1:1, I'm going to make back that profit side, that 4% that I lost. That's not the way to trade, because guess what? If you risk that 4% and you end up losing that 4%, instead of you being down like 4 or 5%, you'll now be down almost 10 or something percent. And if you continue this habit of trying to double up when you encounter losing trades, trying to recover the profits, the losses that you took, with one single winning trade or whatever, then you're just setting up yourself for failure, because at the end of the day, you blow your account before you know what's even happening. Okay? So you need to understand that whether it's support and resistance, whether it's smart money concepts, whether it's trading with indicators, whatever the case may be, whatever it may be, you are not going to win 100% of the trades you take. And that's why there's such a thing as win rate out there in the markets, because you're not going to win 100% of the time. And the thing that a lot of traders don't even know is that even if you were to win like 90% of the time or 90% of the trades you take, let me give you an example. Let's assume that let's skew these numbers. Okay, let's change these numbers a little bit so that I'll illustrate my point better for you. Okay, so let's assume that you are trading with you took the same 100 trades. Okay, the same 100 trades, but then instead of losing 60 trades and only winning 40 trades, in this particular example, you actually lost only 10 trades, but you won 90 trades. So in this particular example, your win rate is 90%. But there's a small caveat here, because whenever you lost more than you won. Okay? So let's assume that every time you got a winning trade, you only made 1% of your account's capital in profits. But then every time you lost a trade, you actually lost 10% of your account's capital on a single losing trade. Now in this case, if we work the numbers out, you'd notice that since we won 90 trades and each winning trade brought us a profit of only 1%, and we had 90 winning trades, this is going to translate into being 90 winning trades with 1% profit per trade is going to be 90 times 100, which will make your gross profit, not net profit, your gross profit 90%. But then for each losing trade you had, remember, every time you took a losing trade, you lost 10% of your account's capital per trade. Okay? And so your loss per trade is 10%, and then you took 10 losing trades. In this case, when you multiply that minus 10%, which is your loss per trade, times the 10 losing trades you had, you're going to be down 100%. Okay? That's your gross loss. Now, when you do this, just a minute, please. When you subtract your gross profit, which is in this particular example, 90%, okay? 90%. When you subtract that gross loss from your gross profit, you notice that at the end of the day, you're going to end up with a net loss, not a net profit, of minus 10%. Minus 10%. Now, what does this have to do with anything? Well, this is showing you the numbers, assuming somebody is just paying so much attention or laying so much emphasis on, catching those winning trades and only winning. You could ask that person and say, okay, what's your win rate? He'd gladly tell you that my win rate is 90%. But then when you do a little bit of digging, you'd find out that at the end of the day, this person is not even profitable. This person even ended up losing money instead of making money, okay? He's even down minus 10% on his account. Even though his win rate is impressive by in and of itself, when he tells you that his win rate is 90%, you think that person is making money, he's making bank. But that's not the case. And that's the problem, because a lot of traders, especially new traders, they go out there thinking it's all about, finding that holy grail trading strategy that's going to win 90% of the time or 95% of the time. And, they ignore everything else. And all they want is just that trading strategy that's going to give them winning trades more than they would have losing trades. The reason, and this is totally understandable, because as a human being, usually our predisposition is to run away from anything that causes us pain. And losing trades, by virtue of them being losing trades, cause us to feel pain. And so most traders who don't know any better, or even the ones who know better but they just don't want to change, are usually going to keep trying to, run away from getting losing trades no matter what they do. Let me tell you something. If you want to be successful in trading, you have to embrace wholeheartedly that you are going to encounter losing trades along the way. If you don't have the mind to embrace this, if you don't have the mindset that you are going to just, be neutral to having those losing trades and expect that the profits from your winning trades are going to counter the losses from your losing trades, trading is not for you. Trading is definitely not for you. Get what I'm saying correct? If you were to go out there and, create a trading strategy or find a trading strategy and you've backtested that trading strategy and for whatever reason, that trading strategy has a 90% win rate and it has a good risk to reward ratio, like every time you're risking 1 to make 2, the trading strategy still delivers. And you take something like 100 or 200 trades with it and it still has a 90% win rate or 80% win rate with still that 1:2 risk to reward ratio, that's a good trading strategy. That's a very, very good trading strategy. In fact, trust me, a lot of professional traders would almost give an arm and a leg for such type of trading strategies. But what I don't want for you is for you to go out there only looking for trading strategies that will give you winning trades more than they give you losing trades, even if their risk to reward ratios are bad, because that is going to be a recipe for disaster for you. You're not going to make as much profit as you think you would. Okay? So we've spent a lot of time explaining this, but this is because understanding this is what's going to make you a better trader. It's not because support and resistance works or SMC works or moving averages work or trend trading. No, it's not all about all of them. Trust me, if you try hard enough, you'd find that a lot of the concepts that are out there, they do work. But still, even though they work, 90% or 95%, as some statistics would quote it, of traders still lose money. So why is that the case? It's simply because, like I told you here, most traders just cannot accept losing trades. I might show you that support and resistance works here. I'll tell you that if you trade with a good risk to reward ratio, it works and all of this. But then when you get into the live markets and you are trading in the live markets, only for you to find that, okay, you took one trade and then that trade was a losing trade. You said, oh, you know what? The coach said that, we're going to have losing trades. I understand. I know I'm doing proper risk management. I'm doing good risk to reward ratio and everything. It's nothing. I'm going to commit. Just like I promised, I'm going to commit to taking 100 trades with this trading strategy before analyzing my trading performance. Okay, so I'm not going to change anything. I'm going to trade whichever trading strategy I chose to use, whether it's support and resistance or whatever. But then you take the second trade, and it's still a losing trade. By this time, you're starting to get a little bit, those doubts are starting to creep in your head, and you're starting to think, okay, maybe I should not take this next trade or whatever. And then you take the third trade. You ignore everything, the doubts and all of those things you're hearing in your head, take the next trade, and it turns out to be a losing trade. Guess what? Even a lot of professional traders, they find it very, very difficult to continue doing this after 3 losing trades in a row. And here I am telling you that not only 3 losing trades, in fact, there could be times that you would get much more than 3 losing trades in a row. But the secret to being profitable in trading is for you to keep going, even in the face of losing streaks. Because just like you had 3 losing trades in a row, it's not impossible for you to have 2 or 3 winning trades in a row as well. Okay? But you need to understand that you cannot judge the performance of a trading strategy based on just a single winning or single losing trade or whatever the case might be. You need to keep going. If your goal is to take 100 trades, you have to take all of those 100 trades with proper risk management, with resilience, with discipline, with all of this before you can see good results. Okay? So I hope this makes things clear, please. I hope this clarifies things for you, okay? Okay, now that we've looked at one example of a trade you take using support, okay? That's when they have a switch in a reversal in roles. That's when a resistance area, after it gets broken, it turns into support. Now that we've looked at one example of a trade that you could take like that, let's look at another different example where you are actually going to be taking a trade based off of a support area or a resistance area acting the way they are supposed to act in and of themselves. So here's an example. When you look at the charts closely here, you notice that what we have somewhere around here is kind of like a resistance area. And why do I say this? It's simply because when price reached this area on the price chart, you notice that price found it difficult to break above this area to continue moving up. So when it came here, it couldn't move any further. And so it pulled back from this area. And then the next time it tested this area, trying to break above this area, it failed to do so. Now, assuming you saw that, okay, price came somewhere around here and it failed to move any higher. And then it pulled back. And then when price retested this area, it's not as if when it came here, it formed a big green candlestick like the one you're seeing here and it broke above this area. No, it's in fact, the momentum it had, it started to slow down as soon as price started coming towards this resistance area, meaning it's beginning to respect it. And so when you saw this type of candlesticks being formed, this indecision candlesticks, dojis or whatever you might call them, and then this big bearish engulfing candlestick, this would be your cue to take a trade, a short trade here with a stop loss above this area. Why? The reason is simply because when you would have seen this, this would tell you that it looks like price is going to respect this area. Because it came here in the past, it couldn't break above it. And now when it's testing this area for the second time, it looks like it still doesn't have the strength or the momentum by the bulls who are pushing prices up to push prices way beyond this area to continue moving up. So the final nail in the coffin would have been this red bearish engulfing candlestick. Okay, when this red bearish engulfing candlestick got formed, this would have been the nail in the coffin, telling us that, okay, it looks like price is going to go down. Now, does this mean that if you were to sell or take a short trade here with your stop loss above this area, that price is not going to, for whatever reason, price cannot just come down a little bit and then go up and hit your stop loss? Absolutely not. And that's the reason why I did this whole long explanation about risk to reward ratios and everything, is because you need to understand that whatever trading technique you're using, whether it be support and resistance, whatever it is, you're going to have winning trades and you're going to have losing trades. At the end of the day, you need to put yourself in a situation where even if the losing trades you have, after you take a large number of trades, because you need to let the rule of large numbers, the law of large numbers, play in your favor, okay? So we're not saying you should just take 5 trades and then after taking 5 trades, you go like, you know what? You said this trading strategy has a 40% win rate, but all of the 5 trades I took were losing trades. Actually, that's not the way it works. You need to take a large number of trades, ideally something like, anything between 30 to 100 trades before you're going to say, okay, this trading strategy, let's analyze its performance and see, okay? So assuming you were to do all of this, okay, you still need to factor in that, okay, I might lose more trades than I win. How can I put the edge in my favor? And the simple answer to that is risk management. It's because a trading strategy, just like I showed you, can be a very, very good trading strategy, 90% win rate or whatever the case might be. But if you don't have proper risk to reward ratios, if you don't have proper risk management, if you don't factor in all of those other things with good trading psychology, guess what? You're still going to struggle to make money. It's that simple. Trading is not an isolated thing where you only need a good trading strategy for it to work. No, you need a good trading strategy coupled with proper risk management and the mindset to face whatever challenges you might face when you get a losing streak and keep going. Or the mindset that you get a series of winning trades and instead of you getting greedy, okay, with those dollar flashes in your eyes, trying to make, whatever, trying to bet the firm and then, make everything and just go on a crazy spree and risk all of your account on a single trade, you need to be disciplined enough to know that trading is a probabilities game. You have to play by the rules. And the rules are get a trading strategy that will give you an edge over the market, practice proper risk management, and then even if you are to get 10 losing trades in a row, do not deviate from your trading plan. Stick to the plan and keep doing what you do. Okay? So in this particular example, again, this is where we saw that price was rejected at this resistance area. Okay, so the assumption is that when price retests this area and it gets rejected again, and we saw something like this strong bearish engulfing candlestick, this is our cue to sell this currency pair. This is just a setup, another setup on the chart. So when we draw this kind of like an area, like I told you earlier on, support and resistance is not a single digit price level on the price chart. Okay, it's usually kind of like an area. Okay, you can see. So this is one trade setup that we would have seen. So if you were to take a short trade here, for example, after seeing this, and you stuck to your rules, your stop loss would be somewhere above this area, because if for whatever reason, price that was finding it difficult to break above this resistance area, if for whatever reason, after you took this trade in and around here, price for whatever reason decides to keep moving up, then this trade is invalidated. Because the reason why we took the trade in the first place is because price was struggling to break above this area and it failed to do so. And when it returned to this area, it still struggled to break above it. So we're taking a short trade here with the mindset or the assumption that price is not going to be able to break above this area. But even if it does, because there are times when we're going to assume that it's going to do this and it's going to do another different thing. But even if it does that, we are prepared to take the loss, because it's just a 1% loss on our accounts. And we're exposing ourselves to make a profit of 3%. So the risk is worth it. If we're wrong, or if price doesn't agree with what we said, then we're only going to lose 1%. But if price agrees with what we said and it reaches our profit target, we're going to make 3%. So if we keep trading like this, and like I showed you the number earlier on, even if we lost more trades than we won, we'd still end up being profitable, because we've got risk management, not only the trading strategies edge, but we've also got risk management in our favor. Okay, so in this particular example, again, we're going for a 1:3 risk to reward ratio trade. And you can see that obviously price would have hit our profit target here. Okay, so we would have entered short here, stop loss above here, and then this would have been our profit target 1 to 3, and price would have hit our profit target. Now, the examples I showed you here, the two examples, the one example of the trade I showed you here was where you would see a role reversal between a resistance area, which would eventually switch into being a support area after it gets broken through the upside, okay? And the next one is an example I showed you where a resistance area is actually acting as a resistance area, and we're taking a trade off of that. Now, as fate would have it, all of the two examples I showed you here were winning trades. But does this mean that, again, I keep saying this because a lot of traders, they would watch things like this, they would watch tutorials like this, and they'll be like, yo, you know what? Support and resistance is the best thing since sliced bread. Okay? And they'll go out there and they want to trade. They will not even back test it. They will not trade on historical data in a simulated environment to prove that what they've learned actually work. They will not do that. They will not trade on a demo account. They will not do that. They will not even trade on a small live account. Most times, some traders, because of desperation or whatever the case might be, will even go and borrow money and then fund a live account and just place a trade based on what they just watched a couple of videos on. And that's not how trading works. That's not how trading works. That's why I keep telling you. That's why in the beginning of this video, I gave you an example of saying, okay, even if you were to learn this concept, even if you were to practice them, and you eventually made like a 60% return on investment, for somebody who is just getting started in the game, you might be rushing and you might think that 60% profit on $100 account, that barely paid for the internet I used to access the market to trade. But then that's not the way you should be thinking. The way you should be thinking is, if I was to hone this skill, learn this skill, perfect this skill, today I might not have capital, but if I have a track record, if I know what I'm doing, if I learn pretty well and I have a track record, eventually the capital is going to find me when I know what I'm doing. Okay? So that's the mindset you should have. That's the mindset you should have. Okay, so this pretty much brings us to this week's edition of the end of this week's edition of the ITU Forex class, okay, where we're talking about support and resistance and all of that. And you can see we didn't just talk about support and resistances. We talked about support and resistance in conjunction with the other key things you need in your trading to become profitable. Things like your risk management, things like paying attention to your psychology and your tolerance and all of those things, okay? Now, these classes that we do, the ITU Forex classes, are more in line with you being taught methods and concepts and trading techniques which are manual in nature, which would require you to engage with the market by analyzing them manually, doing your risk management manually, doing all of those things, you being in front of the charts and doing the work, okay? But we've also got a segment of the company which is invested in giving you tools, bots, which would analyze the markets, do the risk management, do everything on your behalf. They'll do it in an automated fashion and give you an edge. They'll practically help you to make money while you sleep and manage your risk also while you sleep. If you follow the risk recommendations, which we tell you to, and you don't go trying to make $1 trillion in one trade, then you're obviously not going to blow your account. So if you're interested in that, get in touch with the ITU support team, message us on the socials or anything, and we're going to get back to you and help you out, help you set it out with step-by-step guides and everything, okay? So this pretty much, like I told you, this pretty much brings us to the end of this week's edition of the class. If you have any questions, feel free to ask them in the comment section. I look forward to be getting in touch with you guys in next video, and hopefully we're going to crush the markets, okay? So once again, thank you very much, and God bless you all. See you in next week's edition. Cheers.